Good morning to our wonderful audience, and a big welcome back to the big, beautiful boutiques on Wednesdays. I see weather in South Africa and ice running amok all over the US. Fun times indeed. Today, we will look at global equity markets through the eyes of Mazi Capital. And the one thing that matters in fixed income when it comes to the budget, bonds, and currency. It's my great pleasure to welcome back to Boutiques on Wednesdays two gentlemen that you are very familiar with. Simon Deploy from Corion Capital and Andreas van der Horst from Mazi Asset Management. Gentlemen, thank you so much for joining us this morning. Always grateful for your time. How are you doing?
All good, thanks.
Nothing to
Fantastic.
complain about. Thank you, Eugene.
Good stuff. Simon, you are up first. You'll be followed by Andreas. And to our audience, you know how it works by now. If you have any questions for either one of them, please post it in the Q&A bubble, and we'll get to that after both presentations. Simon, you're up first. If you're ready, you can share.
Perfect. Let me get started.
Yeah, I can see your slides, presentation mode, all good to go. Thank you so much.
Thank you, Eugene. Yes, since we only have 15 minutes, and I think fund managers are often guilty of going into too much detail on a topic. I thought this morning, given the time constraint, we'll do the opposite and just really focus on that one thing that matters when you look at a particular subject. And given that in the last 3 months we had a budget 3 times revised, and that the currency blew out to nearly 20, and that our bonds took a hit of about 100 points widening. I think it's poignant to look at those topics. So without much further ado, let's move straight onto the budget. So eventually we did get a budget out of Parliament, and this is a typical slide from the National Treasury pack that comes out, and it does highlight some of the main points that one looks at. There is the GDP growth rate, which I think a lot of people think is the most important thing. You get your expenditure and your revenues, that's quite important. What's your debt to GDP levels, and then you get your budget, primary deficit or balance. Now, out of these 4 things, the one thing we believe is more important than anything else is your primary deficit or surplus. Is your government running a primary balance surplus? That's the most critical thing for us. And the reason is, as the moment you start doing that, it means you are digging yourself out of your debt situation, slowly but surely. You're no longer borrowing to pay interest, and that's the most critical point to get into. Yes, it is obviously important, to follow this up with economic growth. Yes, it's important to get your debt to GDP levels down. But if you can't get to a primary surplus, it means the government isn't disciplined and they can't get the expenditure right. The fact that National Treasury has now for 2 years in a row managed to run a primary surplus, and now for the next calendar year we're on track to do it 3 times in a row, is very encouraging for our national debt levels, and really what we need to get our debt levels under control. Will they get to a 2% primary surplus in about 3 years' time? I don't know. I think that might be a bit on the optimistic side, especially if you dig into the detailed numbers. But as long as we can keep this positive, that is really encouraging and good for our bond market. In terms of the currency, let's move on to that. So in April, post-Liberation Day, we saw the currency blow out to nearly 20 against the dollar and nearly 22 against the euro. I don't know if it actually, I think it might have touched 22 on the euro. It didn't. It stopped 10 cents short on the dollar. But then if you go, and this is the USD, current USD ZAR from 2000 to 2025, and the same for the euro ZAR over the same period. The line in blue is just the inflation differential between the 2 countries. And in the euro, it obviously is the average inflation in the Eurozone. And what's fascinating is that every time the rand blows out, it sort of reached this same level, adjusted for inflation. So yes, in Renegade it was about 17, in COVID it was about 19, and then the last two crises it was just short of 20. But once you adjust it for inflation, it's about the same level. It's actually never been worse than the blowout back in 2001 when the currency went, from 6 to nearly 13 in the space of a year and a half. But be that as it may, you get the same line on the Eurozone. Now, what I found fascinating is that the currency always found support at these levels. There is sort of a lower limit that brings the currency back from the edge. And the question is, what is that? It doesn't mean it can't get worse, but what has to change in order for the currency to decisively go much weaker than that particular point? Now, to understand this, I thought let's just briefly look at two other countries, which emerging markets which have similar stories than us. Brazil had an IFM bailout back in 2001, and its currency follows the same pattern as ours. It never breaches a line that sits at this peak here. In fact, from its IMF bailout in 2001, it actually recovered most of the losses within a year and actually strengthened to well below its initial levels into the commodity boom. On the other end of the spectrum, you sit with Turkey, where President Erdogan has been now in power for more than 10 years. And since 2018, it's been a one-way direction in that currency. And particularly in the last 2 years, it's halved every 12 months. It was at around the level of 10 back in 2022. It reached 20 and it's now at 40. It's one-way traffic on this currency. It just keeps depreciating. Yet Turkey's debt level is only 25% of GDP. That's not very high. In fact, it's much lower than Brazil or South Africa. What's the difference between the two? And what's in common with Brazil and South Africa? A strong central independent bank. Central bank independence is the most critical thing on your currency. And as long as you've got that, your currency will have support, or very, very likely to have that. Now, there's a lot of criticism against Kganyago. He's definitely a monetary hawk. He loves to keep interest rates high, possibly too high, what is good for the economy. But that is also the same thing that keeps the currency under control and keeps inflation in check. So, it's a tough choice, but given how important it is that our currency doesn't blow out in terms of our inflation, in terms of our debt, that this is definitely the kind of central bank that you want. Last one, bonds. When buying bonds, what valuation metrics should you be applying? Like, what should you be looking at in order to get your valuation right? Here's the interest rate cycle, the JIBAR in green, and you can see there's an interest rate cycle going up and down, and there's the bond, and there's the 10-year bond of South Africa. And you can see for the most part over the last 15 years, bonds have been going weaker. And yet over that same time, bonds have actually outperformed cash. So what drives this valuation? Is it a spread above cash? Is it that you should earn a sufficiently high spread, more than cash, and that's when you should be buying bonds? Yeah, that's part of the story. You can see that at about 3% above cash, and where we are currently, that normally is a good time to buy bonds. You do get your outlier periods, COVID, post-COVID, when interest rates was very low and rates was very high due to government deficits. That's an outlier period, and we need to treat that with the appropriate caution. A commodity bull market that drastically lowers your government debt can lead to an inverse yield curve. You should treat that with caution. But by far the most important determinant for bond direction is if there's an interest rate cutting or hiking cycle. Single most important driver. Cutting cycle from April 2003 to September 2005. JIBAR got cut by 6% and the 10-year bond rallied 2%. Hiking cycle that followed, a 3% sell-off in bonds in terms of the yield curve moving up. And this cycle repeats every single time. So we've had 3 full cycles. We're into our 4th cutting cycle this century. And as things stand, we're 1% down. Luckily, with the interest rate cut we received last Thursday, and the 10-year bond has rallied, 60 points over this period. So much more important than trying to assess your bonds relative to cash is to understand where's your monetary cycle and where it's heading, and adjust your duration in your portfolio accordingly. So let's briefly just look at our portfolio positioning given these one things that matter. For us, we're quite comfortable running, a moderate level of duration at this point in time, especially because we're in this interest rate cutting cycle. We're happy to have quite high duration in total to the government, because we believe, the fiscal situation is, although precarious, and which is why we're not running much higher duration, is slowly being brought under control, and we are seeing the reforms that we need. And then importantly, on the currency, we know that as long as the central bank remains, independent, we're willing to sell dollars into our sell-offs, but then immediately buy them back, when the currency strengthens. So you'll see we always have a portion of our income fund that's unhedged, to protect against these sell-offs in the currency. But then when the rand reaches 20 to the dollar, we will actually lower our exposure from around 6% down to about 2%, in order to capture those gains. So just to conclude, you can see that that's worked very well for the fund over the past year. We've comfortably outperformed our benchmark, which in this case is STEFI Composite, and as well as the CISA category. We've got the positioning right, and furthermore, the long-term track record of the fund remains intact. Officially, we're trying to beat STEFI +1, but due to a favorable, yields on government bonds, we've actually been able to achieve that well ahead of it. And due to wide diversification in the portfolio, maybe some property shares, maybe some foreign bonds, maybe some international credit, so different ideas at different points in time, we're able to run this portfolio at much lower risk than many of our peers. So a better return at the lower risk is really what your clients should be after. And just overall in our house, you can see we apply this philosophy not only to our income fund, but across our multi-asset portfolios, and we're getting consistent results, across the house. And that's it from me this morning. Thank you, Eugene.
The one thing that matters, that performance slide right at the end, impressive indeed. Simon, thank you very much. Andreas, we're ready for you. That was a quick round. If you can share from your side.
Okay, morning, Eugene. Just give me a moment here just to get organized. Share that. Are we looking? Is that good?
Yeah, your swing coming through. All good. Yes, there we go.
So see that we've got business. Okay, there we go. Okay, Eugene, thank you again, really, for this opportunity to speak to the BCI family. We always appreciate it. Ladies and gentlemen, good morning. Today we're going to kick off with a series of short webinars where we explore the building blocks of our quality investment philosophy and investment process. And today we are going to talk about capital allocation. Now, you might remember the old film from 1972 that dealt with the Watergate scandal, All the President's Men. So in this flick, there was a character called Deep Throat, and he popularized the expression, follow the money. So today, follow the money is what we're going to do when we look at companies. We're going to try and figure out what management does, whether they're building value for their investors or whether they're destroying it. Let's recap on our quality investment approach at Mazi. We do 5 things. First off, we want to find the best businesses in the world, and there really aren't many of those. So when we find them, we pay close attention. We just don't compromise on quality. Secondly, we research our businesses deeply. It is our job to know our companies inside and out. Thirdly, we buy them at the right price. So if I take a great business trading at $400 today and we bought it at $100, that will be up 4-fold in our hands. But the same company bought for $200 has only doubled. So valuation is really our runway for future returns, and it's critical that we get that right. Entry price does matter. Then the fourth thing we do is we think and act like owners, and we let our businesses grow and compound with time. Those of you who have listened to us before, you'll know we always tell you about Charlie Munger and what he said. The big money is not in the buying and selling, but in the waiting. Patience really does pay. And lastly, we're disciplined. We monitor our businesses very, very closely. If the facts change, we're going to change. We're going to act decisively, and we're not afraid to admit where we are wrong. Quality investing, ladies and gentlemen, is conceptually very simple, but it is very, very hard in practice. And that is why process and consistency matter so much in investment. So, what does a good CEO and a world-class management team actually do? They do two things. One, they have to run the company well. That means they sell things, they deliver them to customers, they keep customers happy, they manage the staff and suppliers, all the basic operational things. And as investors, we want to own well-oiled machines with a good culture, good people, strong controls, and above all, repeatable business execution. So these are the day-to-day business matters that CEOs and company management have to take care of. And the second thing is they have to allocate capital. In other words, after everything's been paid for and the cash that is left in the business, what do they do with it? And this is where long-term value is born or buried. Capital allocation is ultimately the scorecard that you measure management by. So management has 5 levers of how they can allocate capital. The first is they can reinvest in the business and maintain what is there and what works. And they can then invest for growth. In other words, widen that pipe of future free cash that is coming at investors and at the business. Another thing they can do to allocate capital is they can buy another business. Maybe they need something small, something complementary, a little bolt-on or tuck-in as we call it, or they can do something bigger, a much, much bigger deal. But the key thing here is if you pay too much or you stray out of your circle of competence, you're going to lose money. The third thing, very sensible, pay down debt. And this lowers the overall risk of the business. It builds resilience and it gives the company optionality down the line to do other things. Fourthly, they can share in the profits by paying us a dividend. Usually that's a sign of confidence and a robust future for the business. And lastly, they can buy back their own shares. Now, if this is done well, it increases our ownership of the company that we own, and it boosts our long-term returns and can be highly value accretive for us as investors. Now, how management balances these choices, these 5 choices, tells you a lot about the types of stewards that a management team are of your shareholder wealth. We want to own those businesses managed by prudent capital allocators, not empire builders. Now, we've looked at what the 5 capital allocation options are, and this is the scorecard for management and arguably the most important decision in a company. But the question is, how do you pay for it? How do you pay for the capex or the reinvestment or the growth of the business? You can borrow it. So this is fine provided that the returns that your project or your investment is going to generate comfortably exceed the interest and you can pay down the debt rapidly. But anybody that knows or has had some debt knows all too well that debt does add fragility. It does put pressure on the balance sheet and it does reduce flexibility down the line. So this is something to consider. The second option is to issue more shares, which dilutes existing owners and is only justifiable where that investment payoff is substantial to all shareholders and is genuinely strategic and valuable over time. And the third is you can use cash that has been internally generated by the operations, excess profits. This is usually the best option as there's no shareholder dilution, there's no increase in debt and riskiness. And if you're able to reinvest those cash flows at higher returns on invested capital, then it compounds quickly. It really generates wealth for shareholders. This is the holy grail of quality investing. This is what we are looking. So the question is not whether you invest, but how you invest and how you pay for it. Now, let's look at what happens when a company gets this spectacularly wrong. Enter Steinhoff. Steinhoff was in the headlines all the time. Acquisitions everywhere, growth, and quite frankly, a darling of the investor community. But if you follow the money, the picture changes. No doubt some of you will be familiar with our company DNA chart. The chart shows over time the return on invested capital that a company earns. That's the green line versus the cost of that capital, the red line. You want the green line to be well above the red line, which means the company is generating excess profits or economic value add. With Steinhoff, and you can pretty much ignore everything after 2018 because the creditors were then already starting to close shop. The whole story went pear-shaped and in the wrong direction from the start. From the get-go, Steinhoff wasn't earning enough to cover the cost of its capital. Year after year, the spread was negative. The red line was well above the green line. What were they doing? They were buying businesses constantly using debt, paying ridiculous prices, chasing scale to fill bigger and bigger holes. And in fact, they did exactly the opposite of good capital allocation. As we all know all too well, buying is very easy, but buying well is exceptionally hard. And if you overpay or mismanage your acquisitions, the damage will compound seriously and you will lose money. As you can quite clearly see, growth isn't free, and nor is dishonesty in this case. Now, here's where the rubber hits the road. From 1999 to 2022, Steinhoff reported cumulative, so that's everything from 1999, earnings on a per share basis of 61 euro cents. This is the blue bar in the purple block on the right-hand side of your screen. So that is, but during all of that time, when everything was cashed up, they only produced 5 euro cents of free cash on a per share basis. That's the small little red bar in the purple block. So they generated 1/12 of so-called earnings were converted into cash. This is not a gap in cash earnings. It is genuinely theft. Steinhoff looked profitable on paper, but almost none of its deals generated real usable cash. We all know why Steinhoff was such a mess. Nevertheless, value literally evaporated into thin air, and without cash, you can't reinvest, you can't grow, reduce debt, or reward shareholders. This whole Steinhoff tragedy wasn't bad luck. It was bad capital allocation repeated over 2 decades to fill ever bigger holes in the balance sheet combined with dishonesty. You can buy all the companies and sell all the companies you like all day long, but if the cash doesn't show up, it's just smoke and mirrors. It just ain't quality. Now for the other part of the story. This is Booking.com, a global travel company we've owned for a very long time. Same starting point as Steinhoff, same set of capital allocations choices, but a completely different outcome. Look at the chart. Bar COVID around 2020, the green line is well above the red consistently. The company even survived the COVID black swan event. Now that's shareholder value creation year after year. There can be no argument that the Booking business model works for investors, and clearly Booking's management also knows how to nurture it. This chart shows the result. Since 1999, earnings per share and free cash have exploded. Importantly, they track each other. When the earnings, they also cash. $16 of free cash on a per share basis in 2010 became $235 in 2024. Cumulatively, since 1999, Booking has produced $850 in earnings per share, but importantly, $1,268 in free cash per share. Not only is there more cash than earnings, but these numbers are literally off the charts. These are real profits backed by real cash, no accounting smoke. And what did they do with this cash? They reinvested in their own operations at high returns on invested capital and also sensibly bought back their shares. They didn't buy back the shares to goose earnings or to neutralize management stock options, but rather to compound long-term shareholder value on a per-share basis. A final chart, a simple one. Booking's share price from $285 at the end of 1999 to over $5,600 today. That's 20 times up in 25 years. That's the compounding effect of good capital allocation decisions executed over years. This is the type of company we want to find and hold and not let go of. Let's sum up. Booking made real profits, turned them into real cash, and reinvested wisely and bought back their stock. This is what long-term investment looks like. This is what we like to own. Steinhoff, on the other hand, made headlines, did deals, looked busy, but the cash never followed. The value never showed up, only the disappointment. So we have to ask the question, would you rather own Booking for the long term or Steinhoff? And that's what good capital allocation is about. And that is why we follow the money. To wrap up, does our approach work? The Mazi BCI Global Equity Feeder Fund has delivered, after fees, 13.9% per year over the past 4 years. That's 2.4% ahead of our peer group. We've done 21.3% per year over the past 3 years, 6% ahead, and 12.5% over the past 2 years, also a tidy clip ahead of our peers. Over multiple periods, we have delivered top quartile performance. This outcome isn't the result of luck. It's the result of a disciplined process combined with a relentless focus on quality and patient ownership. Buy the best businesses, pay the right price, let them compound. It's that simple. It's that hard. Eugene, thank you very much.
Andreas, thank you so much. Very interesting indeed. While I've got you on, I'm going to start with a couple of questions for you, a couple of questions coming in from the audience as well. But let's stick to the theme of follow the money. And it all speaks to the pond that you fish in for the Mazi BCI Global Equity Fund. If we look at cash flows or equity flows over the past 6 months particularly, a lot of managers starting to venture into places like Europe, UK, especially value managers. That's what they say, where they tend to find better value at the moment. Do you still mainly focus only on US equity? Do you look at other regions? And what is your thoughts on places like UK and Europe?
That's an excellent question. I'd make a couple of remarks. First of all, the US is a place that rewards shareholders tremendously. It's a place where owners of businesses are allowed to make money. The way in which European capital markets function, Asian and Chinese capital markets function is somewhat different. So that's the first point I'd make. The second point is that in terms of our portfolio, it is true that about 72% of our stocks are listed in the US. But when you look on a look-through basis, the underlying revenue broadly matches the distribution of the equity revenue for the entire world. So we own a portfolio of genuinely global companies. They just so happen to be listed in the US. The third comment I'll make is we've built an extensive suite of data analytics that allows us to find only those companies that satisfy our quality investment criteria. And that practically means that we do find businesses in the UK and in Europe and in China and elsewhere in the business. And when they meet our criteria and our thresholds, then we will invest in them. So that's just where we are right now. We do seem somewhat North America centric, but that's not on a market cap and weighted basis. That's not entirely the full picture.
Quick thoughts on places like, for argument's sake, Japan. I mean, Japan had a good rally, but there's still some exceptional companies there excelling in the technology space. And then what about things like tech based in Hong Kong?
So I've had the privilege of working with Japanese, with the Japanese, and they have an exceptional work ethic, exceptional culture, exceptional commitment to the client. But what they don't have is not an exceptional commitment to the shareholder. So the shareholder always stands very far at the back of the queue. That's comment number one. That doesn't mean there aren't interesting businesses. On this board here on the back, we've actually got a couple of Japanese stocks that we are looking at, mostly companies that have beachhead positions in wafer fabrication equipment. So that's so we're always on the lookout. But I can show you in the data that Japan has historically not, and despite reforms and share buybacks and these companies trading at massive discounts to just, for example, cash on their balance sheets, has historically not been so good for shareholders. On Hong Kong, we have owned, and we still do own businesses listed there, but that does not specifically mean that we are, we're not thematically based or looking in a specific market. So, if something interesting comes along, we will buy in the Hong Kong market.
Interesting indeed. Question from the audience, Andreas, very quickly with regards to your benchmark. Your benchmark is the CISA peer group average. The question is, please explain the relevance of your benchmarks as it's not MSCI World or All Country Index. Is this a fee earning consideration? I think the last part of the question would be no, because you don't charge performance fees. But inside of that, I mean, how impactful is your benchmark or what the peers do in terms of how you manage the fund?
Let me, there are two questions, or two answers in that. There's a regulatory one and there's the real answer. The regulatory one is that we're all governed by this thing called Board Notice 92. So if I had to do about 6 rounds of compliance updates before the presentation was finally accepted to be compliant in terms of all the T's and C's. So in South Africa, you'll see that the majority of fund managers doing global will just track the CISA peer group, because otherwise you have to pay close to R1 million to MSCI to use the benchmark. So that's why we can only disclose that. We then the BCI, our BCI fund is indeed a feeder, and then we have I don't know if I'm allowed to say this, Eugene, in Ireland a UCITS fund, the Mazi Global Equity Fund. And that indeed does have the MSCI equity as the benchmark. In terms of the fee part, we basically only charge the bare minimum that BCI charges us here, which is, I think, is the 15 basis points or something. And then in Ireland, that feeds into a 65 basis points fee class that you pay there. So on a fee basis, it's a very attractive, most attractive offering, we would argue.
Most definitely. And I mean, if I look at your total investment charge, it's sitting at currently at 0.91%, so it's below 1. And it is very competitive for global equity funds indeed. And to the audience member that asked that question, if you need to know more about the explanation on not using MSCI and in SA, fund managers actually has to pay a fee now to use that as a benchmark. That's the only part of the fee equation that really comes to play. It's silly stuff at the background, but like I said, the UCITS fund tracks the MSCI, so very important that. Simon, if I can maybe come to you, and I want to unpack the portfolio construction of your fund a little bit more, because the fund is actually an all-round solution for clients. It's not entirely a single managed fund. You manage a component of the fund, but you also look at combining other fixed income strategies in the fund. I know you presented on that before in previous occasions, but maybe just as a recap to the audience, just take us briefly through that portfolio construct thinking.
Thanks, Eugene. Yes, so we manage the majority of the fund. We manage about 70% directly. And then when we find strategies that offer something unique or different, or that we can't do in-house, we're often quite comfortable allocating to an external manager in order to do that. So, for example, We've got Oakhaven in there. Oakhavens are absolute specialists in bank capital and understand the bank sub-debt market really, really well. I think better than anybody else out there. So we're quite comfortable making an allocation to there where a manager can very quickly shift between different parts of the capital structure in order to extract value there. So as much as we're the primary manager of the fund and have 70% internal, we don't mind using an external strategy where it makes sense. And I think that's consistent with all the funds in our house.
And I mean, like I said in the question as well, I mean, your fund is a good all-rounder, almost covering all different, all types of fixed income or yield generating type of strategies. So it's not only, floating versus fixed rate note fund. You also incorporate things like ILBs. I wanna get to ILBs because it's something that is a bit mind-boggling to me, because ILBs are, they've been well priced for the past year, but you just don't make money out of these things. Um, when and how do you decide to buy into ILBs? I understand the use of ILBs and longer dated mandates like a medium or high equity mandate. It does make sense there. But how do you bring that into a fixed income solution? And is it now the right time to buy ILBs? I don't know.
The short answer is yes. Eugene, yes, we try to. I think one of the most critical things to get right in especially a fixed income is to have as much diversification as possible. So we search as many instruments as possible. Often small exposures, 0.3 or 0.5% because we don't want too much concentration. But we've still got some pref shares in there. We've got property shares. We've structured some notes through the banks of various types to give you a different yield payoff profile and mitigate the risks, the major risks in the portfolio. Specifically on ILBs, you say they haven't really made money, but the contrary is also true. They haven't really lost money. And so what we there see is a very cheap option against protection against inflation. So, with inflation at 3% and ILB yields at 5%, that gets you an 8% yield. That's already above cash. So even if inflation comes down to 2%, you're still breaking even with cash. But critically, then what you get is you get the protection of inflation suddenly spiking for you. Typically, this would be an external reason, oil price possibly, going back to $100. Now, you can't imagine now what would be the cause of that, but ever so often we also didn't see a Russia-Ukraine war coming around in 2022. So, and that's the big rationale. They're offering you a very attractive real yield. You're not losing out against cash, and you're getting a very cheap protection against higher inflation.
This makes sense, and it speaks to a little bit of that scatter chart of yours as well. It's not only about maximizing returns, it's about mitigating risks as well. So again, all-round solution. Let's just talk about bonds specifically in your duration. You mentioned sitting at about 1.4. Last week, Wednesdays, you briefly touched on that. I think it's the first time in 3 years that bond yields actually, or the 10-year bond yield dipped below 10. Saw a significant rally in SA bonds. And I mean, let's be honest, investors have been spoiled in fixed income the past 18 months, phenomenal returns the last 12 months. But what can investors expect going forward? I mean, is the party really over, or are we in an environment where fixed income funds can still likely, and I'm not talking about the new inflation target, we'll come back to that, but give you a real return of between 4 and 5%?
On average, it's the short answer again is yes, because that's the yield that you're collecting at the moment. So your 10-year bond, the 2035, gives you now just below 10%. Inflation is at 3%, and you can do the calculation. If inflation just goes back up to 5%, your yield that you're earning would still be inflation plus 5%. So one would expect, that you're getting in excess of inflation +4 yields comfortably in bonds. I think the caveat is that it's not going to be a smooth ride. What the charts on the budget show is that as much as we're moving in the right direction, we are incredibly vulnerable. Our debt GDP is too high. Our primary surplus is not large enough. Our growth rate is not high enough. So the case to hold them is compelling, but there is risk, and it's not going to be a smooth ride. I would be pleasantly surprised if from here on, it's a smooth rally for bonds down to 8%. Very happy if it happens, but I wouldn't be surprised if we touch 11% or even 12% on the 10-year bonds.
And I mean, the reinvestment rate still remaining very attractive as well. So I think we mustn't forget about that. Question from the audience, and I think everybody wants to know about this. Inflation targets coming down to 3%. How will this impact on SA bonds? Is this positive, negative?
So we actually just did a lot of work on that, and we busy preparing a presentation on that for our clients this Friday. Based on everything we can see, it needs to be very supportive for bonds, and it again boils down to straightforward maths, and I think that's why bonds is often considered very mathematical. Kganyago has been very getting under the skin of a lot of South Africans due to keeping rates high. But the one thing we've learned about him is he is very systematic in his approach. He believes that real rates should be 2.5% to 3% above inflation, and he believes inflation needs to be strictly contained. So, but that also puts him in a bind. That he's very succinctly and forcefully iterated that view. But then what also happens is if he gets his 3% inflation target, he has said that his neutral rate then becomes 5.5% for cash. Now, if investors demand a 2% premium above cash for the bonds, that puts the neutral rate on bonds at 7.5%. And if you want to put an additional risk of that of where we are at the moment, that puts it at 8.5%. So one would think if there is an official lowering of the target to 3%, and I think we are still a bit away from that, it has to be supportive of at least the shorter dated bonds initially. Maybe the 15-year bonds stay where they are because there's a risk premium, but your 7-year bond, your 6-year bonds, they will need to lower because cash at 5.5, that spread just becomes too wide then. And I think that's why you see quite a lot of fixed income managers, running quite high duration, is that they're simply playing this view that the governor is set on lowering the inflation target, and if that happens, we're going to see lower real rates, lower nominal rates, down to 5.5% possibly, and consequently bonds should follow that.
And speaking of duration, I mean, it leads into another question. After the bond rally, I mean, how do one manage this now? Do you take profits from bonds, or do you follow the argument that exactly what you mentioned now, bond yields, there's room for bond yields to come down a lot more, where you can possibly see some capital gains? So do you maybe, rather than on the other side of the argument, up duration? How do you play that?
I think you always adjust for the risk. So when yields come down, you're being less compensated for the risk, and you have to keep the one thing that matters in mind. You have to keep your interest rate cutting cycle in mind and position according to that. So maybe when yields rally, you don't cut as aggressively, but risk has changed. You're not being rewarded as much as you were previously, and you arguably need to have less risk into your portfolio. So we view bonds as highly mean reverting, and we always position relative to where we believe that the long-term average will settle.
And again, it refers back to that scatter chart you had on the portfolio. positioned very well. We contain the risks and volatility and still delivering good returns for the clients. Let's just look at currency very quickly. And Simon, you spoke about currency, and let's look about the following on in the lower inflation target. Could the lower inflation target potentially, in to some indirect way, also protect the currency? Because I mean, in a PPP graph, obviously those differentials would be a lot lower. So by default, it should slow currency weakness. And what is the path of the SA currency relative to the dollar? There's been some strength lately, but it's not necessarily so much a rand argument. I think it's a dollar weakening argument. How do you see ZAR versus US over the next 12 months?
Yeah. Gee, that's possibly
Loaded.
the worst possible question you could throw at me.
I
But,
know.
but in Feb, you did put me on the spot, and it did promptly weaken, and now it's stronger than it was back then. So,
Yes.
to try and predict the currency is fool's errand, to my mind. But you can position on valuation. And I think you are spot on that currencies depreciate at the rate of either the inflation or the interest differential. And you can take either one of the two, but broadly
In
speaking,
in a bubble world. Yeah.
yes, that is the case. So yes, with lower interest rates and lower inflation, you would expect our currency to depreciate at a lower rate. Now, interestingly, over longer periods of time, the currency actually outperforms once you account for the interest. So a lot of people are lamenting how much a currency has depreciated, but you were compensated with the interest. You're better off in rands than you were in dollars over a 20 or 30-year period.
Yeah.
Over 12 months, I think it's all about the dollar at this stage. I think that the world has changed since Liberation Day, as it's known. I'm not sure who was liberated, but and if you look closely, the rand is weaker against the euro than we were 2 months ago. We're weaker against the pound, but we're stronger against the dollar. And all that tells you is that it's the dollar that weakened. The dollar is about 10% weaker than the beginning of this year. And I suspect over a 12-month period that continues. But currencies are volatile and anything can happen.
Andreas, maybe from your perspective, because I mean you run a global equity fund, and from an SA investor perspective, we always have to consider currency if we decide to up global exposure or not. Doesn't matter to which manager it is, and we'll come back to that. But it does seem like the dollar is starting to follow a path of structural decline, because we know the dollar has been too strong for a very long period. We also know that Trump wants a weaker dollar to improve exports from the US. And we also see that the world is not as in love with the dollar as it used to be. They're buying up things like gold. They're afraid that Trump will further weaponize the US dollar. What is the path of the dollar in your view going forward?
That I honestly don't know. If you tell me, I will.
I don't want a number. I just want to see,
In all my
understand,
investment
is the strength going to continue?
to you. But I would make the following perfunctory comments. The one is the dollar still remains the reserve currency
Yeah.
in the world. And as long as a man in Kenya or Nigeria or Venezuela is happy to accept the dollar over his own domestic currency, I think it's going to have a very, very meaningful and important role for a very long time. So that's the first point I'd make. The second point is that the dollar has gone through periods of weakness and of strength. And generally, we own a portfolio where the majority of our companies earn about half, if not more, of their revenues outside of North America. So that generally bodes well for us holding lots of listed US investments. So that is, that bodes well for the profits of our businesses. So that's the second comment I make. And the third comment I make is, because our portfolio is so diversified on an underlying basis, a lot of this currency risk is already managed within these global multinational companies. So it's really not something that keeps us awake. I do like traveling to the USA, so when the rand feels strong relative to the dollar, I just feel slightly less poor when I buy myself a cup of coffee there. So those are the comments I would make. But trying to guess and position yourself for the dollar or against the dollar does become a bit of a mug's game, and it's far better for us to devote our time to finding businesses that are growing seriously and doing so profitably and can reinvest. That has been the best hedge against any kind of inflation or loss of purchasing power from whether it's dollar depreciation or any other currency depreciation.
I think one of the points you made now very, very interesting is, and we can't lose sight of that. It's a lot of the companies that you invest in earnings originates outside the US, so it does impact meaningfully on the earnings of that company. Question from the audience. We know we're spoiled for choice when it comes to global equity funds. There's a whole bunch of funds out there invested from SA, feeder funds as well, like your own fund. But what is the key consideration that the audience need to make considering your fund relative to other global equity funds?
I think that's a very important question. My dad had a very long career in investments, and he came up with the mother-in-law test. Your mother-in-law's always got the odds stacked against you. So if you can explain it to your
I'm worried
mother-in-law
about where
what
it's
to
going to
do,
go.
and it makes sense, then you should probably do it. So what we offer at Mazi is a absolutely proven, bulletproof investment philosophy and investment process. And you don't need to go and look at our well-respected peers. There's a huge body of research and empirical evidence pointing to that quality investment over time does deliver a meaningful real growth in wealth that is typically above almost any kind of global equity benchmark that you want to use. So that's the first thing. The second thing is we give you absolute predictability and transparency. So you should be rolling your eyes the next time you hear our presentation, because it keeps on being the same story, and it keeps on being the same story, but we're applying proven and tested principles to investments to grow wealth for our clients. So I think that's absolutely critical, and having peace of mind in the journey of growing wealth. It doesn't mean it's not going to be volatile. That's what equities do. They do go up and down, but over time, if you stay in the game, and if you listen to Dion Gos's fabulous presentation at the global conference in Pretoria, that is where you want to be. Just buckle down for the ride. And then the last thing is we're an established player in South Africa. We can do that. We've got a proven track record of doing the global equity job from here. And so I think that's tremendously valuable for you, rather than try and go and find a manager in London or in North America or somewhere. You've got quick and easy access to us. So proven track record, good performance, and we're here.
Another question from the audience, and it speaks to the turnover of your fund. Do you have a buy and hold strategy? How often do you turn the fund or shares in the fund? Do you fall in love with shares and buy and hold forever, or do you sell them when you think you've made your money or when a mistake was made?
So lots of questions in there. The portfolio turnover by design is low. So in the opening years or the launch years, it was 0%, 0%, 11.9, 8.5, 11.8, and year to date now it's 4.6. So that's very low. That speaks to a 7 to 10 year holding period. Two, we are not in love with our shares. Although we love all our children equally, they've got to demonstrate who's good at what. And then the last, which is probably the most important thing, and we can do a separate webinar on this because I think it's tremendously interesting, is our sell discipline. So we sell on 4 occasions. The first one is what we call an A decision, A personality type, know everything, super confident. And that's where we get it wrong. And that's where our work is not complete. We didn't understand the business properly. We didn't understand the macro. We didn't understand the environment, and our investment thesis was fundamentally wrong. And then we very quickly self-correct. The second is great business, wonderful story, everything carries on, doing decent investment returns, everything happens, but then something exogenous happens. There's some kind of extraneous thing in the environment, or they announce that they're now going to do a takeover, and that doesn't satisfy our capital allocation criteria. So they do something which we think is irrational, then we'll sell. The third is, although all our businesses meet our quality investment criteria and our thresholds at the time of investment, things do change over time. So there are those that rise to the top of the pack, and then those that fall to the bottom of the pack. And on a relative basis, if we find an opportunity that is more attractive for the long term than the benchmark by a long margin, we're going to include it, and we'll take something out of the portfolio where our expectation is for less sectors. And the last thing is really just the prudential risk management thing, where if a stock starts going towards 10%, we will cut it back to manage portfolio level risk. That is really driven by our institutional clients, who are extremely cautious and have a very, very different risk appetite. But we think that's a prudent and sensible thing to do.
A well-formulated and disciplined process indeed, and it does show in your numbers on both funds of feeder, but obviously looking at the UCITS funds, the returns are definitely there. Gentlemen, the clock is chasing us. I want to take one last question from Simon, and again, similar to the question that was posed to Andreas. Fixed income funds, multi-asset fixed income funds, there's a very long list there. Why the Corion fund?
I think it's our relentless focus on diversification. I think we're one of the few funds that really try and incorporate virtually every asset class. We, one major differentiator is, we've got about 13% in foreign denominated assets, and that's spread against foreign government bonds as well as corporate credit. And I think many mandates that doesn't even allow a foreign exposure, or is unwilling to take it on. And for us, it's a very easy to calculation. If you go and look at the correlation between your local bond market and your rand, they're negatively correlated. That's almost the holy grail in investment. If you can find two assets that's uncorrelated to each other, that's already a great addition to your portfolio. You increasing returns and you're not increasing risk. However, if you can find negatively correlated, it means you can offset the losses of the one against the other. Get protection when bonds blow out. We get protection through the currency, but then we change that exposure to get the benefit. So as long as you're active on that, that becomes really yield enhancing and return enhancing on a portfolio. So the fact that we, apart from the wide range of local instruments that we're playing, the fact that we've got a meaningful offshore portion and meaningfully shift our offshore exposure, not so much that it increases the volatility of the fund, but actually tries and decrease it, is a big differentiator.
It's indeed a one-stop, full-on fixed income solution. You're 100% right. I mean, very few fund managers actually touch on all the areas that you showed or illustrated in your fund. And I would again just put up that risk scatter chart. It's very seldom that you actually see a chart sitting far to the left and the top left corner. So well done again on that, gentlemen. The clock caught us. We can continue this conversation, I think, for another hour. There's so much more to unpack here to our audience. By now, you know how it works. If you want to get hold of either Andreas or Simon, you're more than welcome. Get in touch with us, and we'll put you in touch with them as well. If you want more information on the funds, give us a shout, and we'll get that through to you. From our side, Simon, Andreas, thank you so much for your time this morning. It's always great to have you on these sessions. Always insightful indeed.
Thank you.
To our audience out there, quick reminder, 19 June, the next session, we've got Flagship and Oakhaven, also one of the managers that Simon referred to that they use in their funds. And we're going to continue discussions next week, Wednesday. To our audience, thank you so much for your continued support. And again, to Andreas, Simon, and the BCI team, thank you so much. I'll see you next week, Wednesday.